right, that's the first tick on the Nifty, by the way. That's the opening rate. Looking pretty good, up 160 odd points.
That early morning gap up opening above 17,200 has not held, and some amount of profit booking has set in. The sensex have given up all of the morning gains and are currently absolutely flat.
Absolutely flat right now. What, 7 or 8 points change?
We are practically at the lows, 16,968, 67. The only solace is that perhaps this is not just an India-specific problem. As we just pointed out, markets across Europe have turned sharply lower.
Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track about the 6 hours of the day's trading action in 5 headlines. I'm Reema Tendulkar, and these are the headlines for the day. The sharp fall in Europe spooks Indian stock markets. The sensex gives up early gains, declines over 300 points. Financial stocks remain under pressure, with the Nifty bank falling by more than 800 points from the day's high. An Adani Group spokesperson tells CNBC-TV18 a special-purpose vehicle controlled by Vinod Adani owns cement majors ACC and Ambuja. The statement puts to rest all speculation on Vinod Adani's relationship with Adani Group companies. Reliance Jio hikes entry-level tariffs for new postpaid plans, which still remain cheaper than Bharti's. They also introduced the cheapest available family plan. The move spooks Bharti stock. The stock is down 2%. Ramkrishna Forging and Titagarh surge after their consortium is declared the lowest bidder for a large railway order. A software-defined mobility deal with Honda gives KPIT Technologies a fillip, while PVR surges 1.25% after bullish commentary at its first analyst meet post the merger with Inox. Metals surge as investors bet on higher demand from China. Steel prices hit an 8-month high. Nifty Metal Index up 2%. And here's the lineup of what we have for you in store today. We bring you market opinion from Mark Matthews of Julius Baer and Mihir Vora of Max Life Insurance. In Corporate Voices, we have Umesh Chaudhary, MD and CEO of Titagarh Bag. Starting with the day's market action, Dalal Street failed to hold on to opening gains after European markets fell. The Nifty and the Sensex saw cuts of about 0.5%. Financials took it on the chin. The Nifty Bank ending down 1%. Names like HDFC Limited, ICICI Bank were the biggest laggards. BSE companies have erased a market capitalization of over 50,000 crore rupees in today's trade. Prashant, my colleague, is here with a wrap.
Another down day, almost 70 points lower on the Nifty. And in the last 4 sessions, the Nifty has lost about 750 points. Banks under pressure, but nothing like, not yesterday. Yesterday also banks did not do too badly, but the intensity there has come off a little bit on the downside. But they were down once again. The big loser and winner was, of course, the metals index, which was the winner, and the FMCG index, which actually was the loser. I'll start with the losses on the Nifty. Bharti, IndusInd Bank, Reliance, the heavyweight, lost about nearly 2%. SBI and HUL were down as well. Gainers in the form of Asian Paints, Tata Steel and Titan, which were down. Now, the Adani Group stocks were up. They actually flipped around. They were lower in the morning, but they ended higher. Mostly Adani Enterprises, Ports, Adani Total were some of the notable gainers. Last 2 sessions, they'd actually seen some cracks. Now, in the broader markets, it was very strongly in favor of advances for the first half, but it completely reversed. So losses, lots of them coming through. Mahindra CIE, Spark, IRB, Phoenix Limited, KNR Construction and more. But I have to say, numerically, like I said yesterday, there were more losers, but it was not hugely, in a big way, volume-led downsides coming through for some of these mid-caps and small caps. I guess it's back to watching what the global scene throws up our way. To be fair, overnight, you had a very positive handoff, 2% on the NASDAQ, but the market, of course, here has ended lower. So we have some bit of our own local problems as well, which I think is keeping things on the boil. On top of that list, of course, is FII selling, which has intensified over the last 3 or 4 days. Back to you.
Thank you very much for that. In Market Opinion, Mark Matthews of Julius Baer has said there is no need for big banks to panic due to the SVB crisis. Big banks would actually be a beneficiary. Listen in.
More skeletons can and probably will pop out of closets, but overall, I don't think we need to panic. And in fact, the big banks will be net beneficiaries of this because deposits will go from small banks to big banks.
More opinion coming through. Mihir Vora of Max Life Insurance believes that the Indian economy will be more resilient compared to the global economy. He also lists out the top sectoral bets going forward.
Step back and maybe cut out some of the global noise. Globally, it's going to be noisy. As we have discussed in the past also, our view is that the Indian economy should be more resilient than the global economy. There is much more pain probably out there in the US and Europe because they are not used to 5% yields, 5% interest rates and 6% inflation. So I think there's going to be a lot of gut-wrenching volatility out there in the markets as well as in the economy. I think it would still be domestic financials and capital goods / defense manufacturing segments. I see government continue to be proactive as far as defense spending, defense indigenization is concerned, and the capex spend on railways and roads, etc. And of course, all this, if the domestic economy continues to do well, then retail credit should also continue to do well, which will be good for the private sector financials. So domestic is the theme to go, I would say.
Let's get to the second headline then. Adani Group had a mixed day in trade. An Adani Group spokesperson has told CNBC-TV18 that a special purpose vehicle controlled by Vinod Adani owns the cement majors ACC and Ambuja. The statement puts to rest all speculation on Vinod Adani's relationship with the Adani Group companies. Vivek is here with the details.
Well, thank you for that. The Adani Group stocks continue to remain in focus after a morning context story published on Monday, 13th March, which reported that Ambuja Cements and ACC are owned not by the Adani Group, but by Vinod Adani-controlled entities. In fact, what we've done is we've gone through the entire disclosures made in the open offer document and have independently verified that for Ambuja Cement, that the open offer document was made by an entity controlled by Vinod Adani. The disclosure reads, the ultimate beneficial ownership of the acquirer, that is Endeavour Trade and Investment Limited Mauritius, is actually held by Vinod Shantilal Adani and Mrs. Ranjaben Vinod Adani. The chart on your screen actually indicates the multi-tiered SPV ownership structure of the group. An Adani Group spokesperson actually told CNBC-TV18 that when you're talking about this particular Endeavour Trade and Investment Limited, controlled by Mr. Vinod Adani, the acquirer of ACC Limited as well as Ambuja Cements Limited, belongs to the Adani Group. This fact has been disclosed in our public offer document dated 19th August 2022. The point of concern on this is that the Adani Group had indicated in its response to Hindenburg's allegations that transactions with Vinod Adani entities did not qualify as related party transactions. And as per Indian laws, Adani Group's response on the non-disclosure of related party transactions with Vinod Adani Group entities said, and I quote, all transactions entered into us with entities who qualify as related party under Indian laws and accounting standards have been duly disclosed by us. Further, these have been carried out on arm's length in accordance with applicable laws. Vinod Adani does not hold any managerial position in any Adani-listed entities or their subsidiaries and has no role in their day-to-day affairs.
On the 30th of January, we also had a chat with the Adani Group CFO. This was after the Hindenburg report was released. At that time, the CFO told CNBC-TV18 that he has never had a business meeting with Vinod Adani in the last 11 years at the conglomerate.
I'm the senior most finance executive in Adani Group. I've been there for 11 years. In 11 years, I have not had a business or working meeting with Mr. Vinod Adani. The reason is very simple. He's not the executive in the business. And even I am not aware of how he manages his family offices or how XYZ manages their family office. It's completely separate. And many promoters in India have this. Their family offices are completely separate from their businesses. The same thing is here.
Okay, let's get to the third headline then. And this is on Telecom. Now, Reliance Jio has launched new postpaid plans. So first, let's talk about the Postpaid Plus Jio Plus family plans. Now, these are priced at $399 and $699. The $399 plan also offers an additional 3 add-on connections at 99 rupees per SIM because these are family plans, which means the total monthly charge for a family of 4 is $696. There is also another plan which offers higher value, and that's priced higher at $996 for a family of 4. Now, how do these plans compare with Airtel's? For starters, Airtel Family Plan begins at $999. So for a value-conscious family, Jio's plan of $699 is the only available option and significantly cheaper than Airtel's plan. But the Airtel plan of $999 also is bundled in with certain OTT connections like Amazon Prime and Disney Hotstar, which Jio's $699 plan does not offer. The Jio's higher value plan of $996 is comparable with Airtel's $999 plan because that bundles in certain OTT connections. In terms of individual plans, Reliance Jio's entry-level individual postpaid plan was at $199. But for new subscribers, the entry-level individual postpaid plan will now be $299. That said, despite the increase by Reliance Jio, it's still cheaper than competition because Airtel's plan begins at $399. Question is, can this spur Jio's postpaid growth? Now, Jio's done quite a smart thing because for new subscribers, the entry-level postpaid plans, the tariffs have increased by a whopping 50%. But for a family plan, they are getting aggressive because they are providing a cheaper alternative to peers, but with lower value. Also, their family plans are lower than the plans that they had earlier come out with. So in that sense, they've gotten aggressive. Jio, up until now, has had limited success in postpaid, despite their earlier plans being quite attractive and cheaper. Remember, while postpaid is a smaller percentage of the overall subscriber base, it's a lucrative space given the higher ARPUs. CLSA says although Reliance Jio's new entry family postpaid plan will renew expectations of subscriber gains, postpaid subscribers are not as price sensitive, and Reliance Jio's $996 rupee offer is comparable to that of Bharti and Vodafone Idea's offer at $999. Reliance Jio's individual postpaid tariff hike of 50% will make entry-level plan comparable with Vodafone Idea and cut Bharti Airtel's tariff premium from 100 to 33%. Kotak says Reliance Jio's renewed aggression against our expectation of an increase in postpaid tariffs comes in as a surprise, and it could delay the prospects of a tariff hike in the near term. However, they do not expect Reliance Jio to get aggressive in the larger prepaid data segment. That's all the updates on the telecom front. Get into a break. On the other side, we'll be back in a jiffy with the other headlines. Welcome back. You're still with us on Markets Today, and now let's go over through the rest of the headlines that we're tracking for you. So the fourth one is a compilation of all the stocks that were in the news. Let's start with KPIT Technology. The stock ended up with a gain of more than 8%, and this is after the company announced a partnership with Honda for software-defined mobility, SDV, software-defined vehicles. Well, increasingly, the software component in a car is going up, and now Honda has tied up with KPIT Technology to power their SDM roadmap till 2030. According to KPIT Technology, with Honda, they could be staffing close to 2,000 plus professionals. Why is the stock so excited? Because this is KPIT Technology's second deal in the software-defined mobility space. In November of last year, that's exactly 3-4 months ago, the company had signed a large deal with Renault, and now they're going to be partnering with Honda for the software-defined mobility aspect of their cars, and the street is quite excited with the prospect. The financials of this transaction are still not known, but you can see by judging by the stock reaction, 8.5% higher on KPIT Technology, the street likes the prospects and the fact that KPIT Tech is winning deals in this space. Let's move on now to another stock, Ramkrishna Forging. Now that gained over 6% in trade after Ramkrishna Forging and Titagarh Consortium emerged as the lowest bidder for a railway order. The company will supply around 15.4 lakh forged wheels over 20 years as per the agreement. Sonia is here with the details. Sonia.
Well, thanks a lot for that. So it's a 52-week high, and this is a massive, massive order that Ramkrishna Forgings has bagged. Along with Titagarh Wagons in a JV, they have bagged an order to supply under the Atmanirbhar Bharat project around 15.5 lakh wheels, and this supply will be over a period of 20 years. Now, I had a chance to reach out to the management to find out what exactly this would mean for the business, and the company told me that there's a total outlay of 1,100 crores. That is the investment that they would have to make in this particular project. It will be split between Ramkrishna Forgings and Titagarh Wagons. Out of that, the entire plant will take about 2.5 years to set up. So the project will take about 2.5 years to set up. Initially, they will need about 300 to 350 crores, and the rest of it will be attained through debt, low-cost debt from a European bank. Now, what does this mean in terms of earnings for Ramkrishna Forgings? The company said that they've got a guaranteed order of 80,000 wheels from the government. The total revenue from this project per year would be 2,200 to 2,300 crores, and they're currently putting up a capacity of 2 lakh wheels for this particular order. So it's a new revenue stream for them, orders of forged wheels from the government. It perhaps could open up a gateway for more orders from the government's end, considering the government is going so big in the railway space, and hence the stock is up at a fresh 52-week high, up 7.5%.
Thank you very much for that. Meanwhile, Umesh Chaudhary, the Managing Director and CEO of Titagarh Wagons, said this contract is valued at 12 to 13,000 crore rupees spread over the next 20 years, and the wheel sets are expected to start rolling out in the next 24 months.
The government is saying that we will assure an assured offtake of 80,000 wheels for the next 20 years. You set up a plant. So your base capacity is filled up by us, and then you set up a plant wherein you can take care of the other private requirement and export wheel sets. So this is the tender. The total value of the contract that the railways will place would be about 13,000 crores. But the total project would be much larger than that, maybe more than 2 times of that. This is, we bid in a consortium. It's about an equal consortium.
Another stock which should have been on our radar today is PVR. That surged in trade after bullish commentary at the first analyst meet post its merger with Inox. Another stock that was buzzing in trade was also Voltas after the management commentary was positive again in an analyst meet. Surbhi standing by with the details on both these stocks. Surbhi.
Hi, thanks for that. So today I'll be watching at 2 con calls, PVR and Voltas. PVR Inox had held their first con call as their merged entity yesterday, and there the management has said that they will be adding 200 screens every year for the next 2 years, and they aim that the 40% of these new screen additions will come in the southern part of India. The management expects the EBITDA synergies to be in the range of 200 to 225 crores, and they expected to realize that in the next 12 to 24 months. In the longer term, they expect to drive synergies from additional F&B revenues, ad revenues, and also rationalizing their operational cost. They've also gone ahead and said that they will derive 5% of their spends per head from their food delivery business. Now, most brokerages have a positive view on the stock. CLSA and Nuvama both have a buy rating. The takeaways from the Voltas management meet was also quite positive. They have said that due to the early onset of summer, the room AC sales to channel partners in the month of Feb have been pretty strong. The secondary market share in the month of Jan has been maintained at 19%, and they expect to see further improvement in that. They may take price hikes in month of April depending on the secondary market demand. And on the EBIT margin front, they have said that they expect it to remain at single digits, and they should touch 9% in the near term. On Waldbeck, they plan to launch more SKUs in the near term, and they expect the expansion of the distribution channel to increase by 1.5 times by FY24. Nomura has a buy rating on this stock with a target price of 1,083.
Surbhi, thank you very much for that. Let's get to the fifth headline for the day and the final one. Metal prices rise as investors bet big on demand from China. Steel prices hit an 8-month high. Back home, the Nifty Metal Index soars 2%. Manisha is here with the details.
It has been a good day for metals, where we've seen some short covering and the buying also as the US dollar index continues to trade on a weaker note here. Well, if you look at the overall metals, the non-ferrous metals, copper, aluminum continued to do well. And in the ferrous space, steel was trading at an 8-month highs yet again. Iron ore trading at a 7-month highs as well. And this also came in after Tangshan, which is a major steel producing province, also had to shut production due to severe pollution. So that led to steel prices trading higher. But apart from that, the investors also are betting riding on a strong demand coming in from China. All the economic data that we have seen come in for the month of Feb has been on the positive, some below expectations, but in positive nonetheless. So yet today we are reacting to the industrial production numbers, which are up to 2.4% for the month of Jan and Feb as compared to previous year. The retail sales data also came in 3.5% on the higher side, and the Chinese manufacturing data for the month of Feb has been at a multi-year highs, clearly supportive for the metal prices there. And then there is an expectation that China would have a mandate of further stimulus measures when it comes to consumption, infrastructure and construction, and that has been supportive. Also take a look at the kind of months we are in right now. From March to June is the time which is a peak demand season, and this is the time that metals are high in consumption and stocking. This is the time that infrastructure and construction also are in a very strong go. So metals clearly taking support from that.
Thank you, Manisha, for that. With that, it's a wrap on this edition of Markets Today. Thank you for watching.